All right, Walter Wofford back. Short-term rental cash flow roadmap. We got another step today. So we've looked previously at different models for raising money for the furnishings, the fix-up when you start. Whether you bought it or either you're doing arbitrage, you're still going to need money, and the average that we have is about $12,000. Appliances, furniture, stuff like that. So how do you get the money? So we looked at 4 or 5 ways earlier, and you can go back to another video, but this one's going to specifically talk about assignment of rents, assignment of income. And it's a very interesting discussion because you need to know who the parties are and how it works. And of course, we're going to add the relay banking system to it for transparency. But anyway, it's a good talk if you're interested in this topic. All right, so now, as always, I got Bill and Judy, my AI team, helping me with the content and delivery. And if you would like to see what our properties look like on the Hospitable direct booking site, I recommend Hospitable, then pull out your camera on your phone, focus on the QR code, and then just hit it. And it'll take you right to our website, and you can poke around. All right, so what do we have? We have ways to raise money for the fix-up and furnishings. Assignment of rents. Thank you.
Ever found yourself curious about, well, the unconventional ways entrepreneurs fund their ventures, especially in a really dynamic market like short-term rentals, without just going to the bank? The financing landscape, it's getting incredibly creative. Today, we're taking a deep dive into the fine print of a truly unique financial agreement that's making some of these ventures possible. Our mission today is to really unpack a real-world example of a specific financial instrument. It's called an assignment of rents agreement, short-term rental income. We'll pull back the curtain on its mechanics, explore the benefits, and critically understand the potential pitfalls. For both the borrower and the lender involved, you should walk away with a pretty crystal clear picture of this powerful yet very specific alternative financing model.
That's exactly right. For this deep dive, we're going beyond just theory. We're actually dissecting a literal legal document, an actual assignment of rents agreement. So this gives us a direct, kind of unvarnished look at the precise language and the terms that govern these arrangements. Our goal here is to extract the most important nuggets of knowledge from this document, really help you quickly grasp what this kind of powerful financial setup entails.
Okay, let's unpack this then. At its heart, this specific agreement is between an assignor, right, who is a borrower in this scenario,
correct,
and an assignee, who is the lender. What immediately jumps out is that the loan isn't secured by the physical property itself,
right?
Not like a traditional mortgage.
No.
Instead, the collateral here is directly tied to the income generated from the property. Yeah. It's that income stream that really takes center stage.
Yeah, it's a remarkably direct approach, isn't it? The assigner, they're typically the operator of a short-term rental property. Think, Airbnb, Vrbo, maybe even direct bookings they handle themselves. In the specific example we're looking at, the loan amount is $12,000. And it's explicitly for business purposes tied to that property.
Okay.
So this could be anything from furnishing the place, handling necessary repairs, or maybe just building up some operational reserve capital, which naturally raises the question, if the property isn't the collateral, what exactly is being assigned?
And here's the truly, I think, groundbreaking part that really distinguishes this kind of agreement. It's an irrevocable and unconditional assignment, not just of some money, but specifically 15% of the total gross monthly rental income.
Wow, okay. Gross income.
Gross income. And the agreement explicitly states this isn't just a security interest, which would only give the lender a claim if things go wrong,
Right, like a lien.
Exactly. This is stated as an absolute assignment. So it's not merely a promise to pay from whatever funds they have. It's a direct carve-out, like a percentage slice of the income stream itself that now belongs to the lender. It's almost like the lender becomes a very interested, silent partner in just that slice of your income.
So if we connect that to the bigger picture, this absolute assignment means the assignee of the lender, they gain full authority to collect and apply that specific 15% portion of the income.
No.
directly. The document we looked at even anticipates what they call an anticipated average monthly gross income. For this property, it was $4,000.
Okay, so they estimated up front.
Yes, and based on that projection, it means an estimated monthly payment of, $600 will be flowing to the lender. It makes it pretty transparent, or tries to, for both sides.
So with this absolute assignment locked in, what are the kind of day-to-day realities? The ongoing obligations the assigner is signing up for each month. They have to remit that 15% of the total gross income from their STR operations to the assignee by the 10th day of each month. And that's based on the prior month's income.
Okay, so there's a slight lag?
A slight lag, yes. Yeah. And importantly, this isn't a fixed dollar amount. If the income varies month to month, which it often does.
Sure, seasonality, bookings.
Exactly. The payment still has to be 15% of the actual gross income earned, whether that's above or below that estimated $600. And the assigner also agrees, crucially, to provide documentation if requested. Things like payout summaries from Airbnb or Vrbo or bank statements.
To verify the numbers.
To verify the income, yeah. So, no hiding the rental receipts under the mattress here.
Right. Okay, so once that 15% payment arrives with the lender, what's the very first thing they do with it? How are these payments actually applied?
The agreement we saw specifies a really clear allocation order. First, the payments go towards any accrued but unpaid interest. Makes sense.
And in this particular loan, it's a 10% annual simple interest rate. Simple interest, meaning it's calculated just on the original principal amount, not compounding on already accrued interest. It's pretty straightforward for this kind of deal.
Okay. Simpler than compound interest.
Much simpler. Second, once that interest portion is covered, the rest of the payment is applied to reduce the outstanding principal loan balance. And interestingly, there's a clause that says any payments that come in beyond that required 15%. They can be applied to the principal or held by the lender in a designated reserve account. That's at the lender's discretion.
Okay. It gives the lender some flexibility. Now, let's pivot to the downside. What happens if things don't go according to plan? What if the income dips or stops? The agreement outlines very specific events of default. These include some crucial points, like the assigner failing to make that full 15% monthly payment within 10 days of his due date. That's a tight window.
10 days, yeah.
Or if they materially misrepresent the amount of rental income they've actually earned. That's a big one.
Absolutely. Trust is paramount here.
And another key default trigger is if the short-term rental operations actually cease or are interrupted for more than 30 consecutive days without giving prior written notice to the assignee. That last one, that could be a big deal in a dynamic market. Unexpected major repairs, new local regulations shutting things down temporarily.
Yeah, life happens. So if one of those defaults does occur, what power does the lender, the assignee, actually have? Well, upon default, the assignee has truly significant remedies available. They can, first off, accelerate the repayment, meaning they demand immediate payment of all outstanding principal and interest, the whole remaining balance.
The whole amount, right away.
Right away. But what's particularly notable, and frankly a very powerful clause, is their right to actually contact and notify the short-term rental platforms directly.
You mean like Airbnb or Vrbo?
Exactly. They can contact them to request the redirection of future payouts directly to the assignee, the lender. This effectively bypasses the assigner, the property operator, ensuring that income stream is captured before the operator even sees it.
That cuts them right out of the loop.
Pretty much. And beyond that, of course, they can initiate standard legal proceedings to recover the amounts owed. Think collection agencies, wage garnishment if applicable, or even lien enforcement if other assets are available.
That redirection clause, that's incredibly powerful. And frankly, maybe a bit daunting from the assigner's perspective.
It is.
Does that give the assignee, a disproportionate amount of control? Or is it just seen as a necessary safeguard for this specific kind of alternative financing, where the collateral itself is, income?
That's a great question. It's certainly a strong safeguard, no doubt about it. It's specifically designed to protect the lender, given the unique collateral involved in income stream that, as we said, can fluctuate or even potentially cease altogether.
Okay.
So from the lender's view, it might feel necessary.
So given all these details, the assignment, the defaults, the remedies, how long does this agreement actually last? And how does it eventually end, hopefully on good terms?
The agreement itself remains in effect. It's legally binding until the full loan amount, the principal, and all the accrued interest have been paid back in full. Every penny.
Until it's zeroed out.
Zeroed out. There is some good news for the assigner, though. The document usually permits early repayment of the entire loan at any time, and importantly, without incurring any prepayment penalties or additional fees.
Oh, that's good. No penalty for paying it off early.
Right. And once it is fully repaid, the assignee, the lender, is obligated to provide written confirmation back to the assigner stating that the agreement is officially terminated and it's no longer in effect. Ties it up neatly.
Okay, good. And finally, let's just quickly touch on the numbers again. The document included an illustrative amortization schedule, right? Just to give a sense of the timeline. For this specific $12,000 loan at 10% simple interest, with those estimated $600 monthly payments coming from that 15% of gross income, it projected a repayment term of roughly 24 months.
About 2 years.
Yeah, about 2 years. And over that period, the total estimated repayment would be around $14,400. So that's the original $12,000 principal, plus about $2,400 in total simple interest. So it clearly illustrates how, even with a payment that's percentage-based and potentially variable, the loan is systematically reduced over time until it's fully paid off, assuming the income projections hold roughly true.
Exactly. It shows the path to repayment.
So wrapping this up, what does this all mean for you, our listener? This deep dive into the assignment of rents agreement for STRs, it clearly shows a creative, yes, but also very specific way to finance these kinds of operations. It really highlights the significant power of that absolute assignment, effectively giving the lender a direct ownership stake in a slice of the income stream and the deep financial connection it creates between a lender and a property's gross income.
Absolutely. And for anyone out there considering similar arrangements, whether you're a borrower looking for capital or maybe a lender exploring new investment avenues, really understanding these specific clauses is crucial. Particularly that irrevocable assignment, the detailed payment allocation order we discussed, and of course, those significant remedies for default. You need to know what you're signing or offering. It's a mechanism that seems designed for potentially consistent income streams, but it definitely carries clear risks if that income gets interrupted or perhaps mismanaged.
Yeah, definitely. At the end of the day, this specific type of agreement seems to offer a potentially streamlined path to capital for STR operators.
Yeah.
But it comes with significant leverage and direct control shifting to the lender, especially if things go wrong.
Yeah.
As you've learned today, the devil, as always, is really in the details of these agreements. And knowing those details is where the real power lies for both parties.
Which really makes you think, doesn't it? In a world where income streams are becoming more and more diversified, people earning from digital content, the gig economy, all sorts of things, what other kinds of assets or future earnings could potentially be subject to similar assignment of income agreements? And maybe more broadly, what are the implications of these kinds of financial instruments for personal and business liquidity going forward? Something to chew on.